You've probably heard it, a secret number that controls your entire life. One glance at your phone and suddenly your future feels judged. Somewhere, they say, a banker pulls the levers of your fate. Are you really just a puppet on the bank's strings? One person gets the golden card, another gets rejected for the same life. Every purchase, every payment scanned, measured, judged. Today we investigate, is credit scoring really about control, myth, or reality? Let's find out. Decades ago, loan decisions weren't made by numbers, they were made by people. And people, it turned out, judged more than just your paycheck. Entire neighborhoods were quietly marked as too risky just because of where people lived. So engineers tried something radical, replace human bias with a formula. In the mid-20th century, mathematicians began building a model to predict risk. The goal was simple: balance a bank's risk against a person's ability to repay. One small company built that formula, and it slowly became a global standard. But not everyone welcomed it. People demanded to know how they were being judged. Governments stepped in, writing laws to control how scoring could be used. A single formula was now replacing rooms full of biased human judgment. And with that, the three-digit number as we know it today was born. But whispers started spreading. Was this really about fairness or about profit? Rumors passed from person to person, growing bigger with every retelling. Then social media arrived, and the theory spread faster than ever before. Families denied loans searched for someone, anyone to blame. And a giant faceless institution made an easy target. It felt like decisions were made by machines, stamping approval or rejection without a second thought. People began to feel like they weren't a person anymore, just a barcode. A number, some said, was now more powerful than a judge's gavel. And this system quietly spread across the entire world. Headlines fed the fear, painting the score as a tool of quiet control. So which is it? Let's look at both sides of the story. Argument 1. Banks profit enormously from every score they calculate. Higher risk borrowers pay higher interest, meaning more money for the lender. People feel trapped by a number they can't see or fully understand. The formula itself is often treated like a locked black box. Ask a bank exactly how your score was calculated and you'll rarely get a clear answer. Different companies calculate different scores for the exact same person. A low score can trigger a flood of expensive credit offers instead of help. It can feel like a carrot dangled just out of reach forever. Some feel stuck running on a wheel of debt that never seems to stop. And it's not just banks. Landlords, employers, even insurers now check that number. One score reaches into nearly every corner of modern life. Reports are often confusing, tangled in jargon most people never learned. Critics argue the system quietly favors those who already have money. A low score can lock people out of the very homes they're trying to buy. Some studies have linked lower scores to historically underserved neighborhoods. One rejection stamp and a family's plans can collapse overnight. A single missed payment can snowball into years of financial struggle. Trying to rebuild a score can feel like climbing a ladder that keeps collapsing. It can feel like your entire financial history is under constant surveillance. So people started pushing back, demanding more transparency and fairness. And yes, behind the scenes, this industry has made a lot of money. Every score calculated, every report sold adds up to serious profit. It's easy to see why some call it a puppet show, with banks pulling the strings. Two people with similar habits can somehow end up with very different scores. For many, checking their score feels like pulling a slot machine lever. The exact rules behind the number can feel like a locked treasure chest. For a nervous borrower, that number can feel like it's measuring their entire worth. Complaints pile up, while the institutions behind the system stay calm and quiet. One low number, critics say, can quietly sabotage a home, a car, even a career. It's no surprise then that so many believe this is a system of control. But here's where the story gets more complicated, because scoring wasn't built in secret. It was built to replace something even less transparent: a biased human gatekeeper. Before scoring, two people with identical finances could be judged completely differently. A formula, unlike a person, doesn't have a bad mood or a hidden prejudice. Regulators now actively inspect how these formulas are built and used. Laws were passed specifically to protect consumers from unfair scoring practices. In many countries, you're legally entitled to a free copy of your own report. You can dispute mistakes, and by law, they must be investigated and corrected. The main ingredients of the formula are actually published for anyone to see. Payment history history alone typically makes up the single largest slice of the score. Consistent, on-time payments genuinely and predictably raise your score over time. The system rewards habit and consistency, not luck and not favoritism. Banks lose real money when they lend to people who can't repay. Scoring exists partly to protect the entire financial system from collapse. Lower risk genuinely earns lower interest rates. That's basic, provable math. The formulas are tested against decades of real repayment data, not guesswork. Millions of historical loan records were studied to build a predictive, evidence-based model. Independent researchers have repeatedly confirmed the link between habits and repayment. Lenders can face serious legal consequences for discriminatory scoring practices. Old, openly biased lending walls have been legally torn down over the decades. The most reputable scoring companies now publish detailed explanations of their methods. Similar scoring models are used independently across dozens of countries worldwide. For many families, a good score acts like an umbrella against financial disaster. It can act as an early warning system, keeping people from borrowing more than they can handle. For every rejection story, there's someone else who got approved because of a strong score. Financial educators now teach exactly how the system works, step by step. A score can actually be grown deliberately, like a small plant, with patience and care. Independent watchdog agencies exist specifically to monitor scoring companies. Companies that break fairness rules have faced multi-million-dollar fines. A structured, rule-based system is far more predictable than a stranger's personal opinion. For some, a rising score has genuinely opened doors that were once closed. The tools to understand and improve your own score are freely available today. There is a clear, well-documented path from a low score to a high one. At its core, the formula doesn't care who you are, only what you've done financially. Many of the old, openly unfair lending practices have already been dismantled by law. So where does the truth actually sit between these two arguments? It's not a clean knockout for either side. It's closer to a draw with nuance. Calling it purely a control system is too simple, but calling it purely fair is too simple too. The full picture, a tool built with good intentions used inside a profit-driven industry. Yes, banks profit from your score, and yes, that same score can genuinely protect you. Like any tool, it's neither purely good nor purely evil. It depends on how it's used. Bank profits and fewer defaulted loans can and do rise together. You're not just a puppet in this system. You hold real tools to shape your own outcome. Profit motives and fairness protections exist inside the very same machine. So the honest verdict is partly myth, partly reality, genuinely both. The scary monster from the start of this video turns out to be just a mechanism, not a conspiracy, not a fairy tale, just an imperfect system built by imperfect people. And that's our verdict. Credit scoring is a flawed but genuinely functional tool, not a secret weapon. Understanding how it really works is the first step to using it in your favor. That scary glowing number from the beginning? It's a lot less scary now. But wait, here's a twist most people never expect. There isn't just one score. There are dozens of different scoring models in use today. The exact same person can get noticeably different scores from different companies at the exact same time. And in some countries, formal credit scoring barely exists at all. In a growing number of places, even paying rent on time can now boost your score. Here's the surprising part. Closing an old credit card can actually lower your score. The balance between human oversight and automated decisions is still being pulled in both directions. Artificial intelligence is now being tested to build even more advanced versions of the formula. Some newer models are even exploring phone bills and streaming subscriptions as data points. Experiments are underway to include entirely new kinds of everyday financial data. In some cultures, trust between a bank and a borrower is still built without any score at all. The scoring system of the future may look nothing like the one we know today. The more you understand this system, the less power any myth around it holds over you. Curiosity, it turns out, is the best defense against financial fear. And that's a door worth walking through, toward more knowledge, not less. So, myth or reality? Now you know the real, nuanced answer. If this investigation opened your eyes, hit that notification bell for more. A like helps this channel keep digging into the myths that shape your everyday life. Tell us in the comments, which myth should we investigate next? Until next time, keep questioning everything. Stop Myth is waiting.